Nigeria's inflation rate rose to 12.82% in the month of July, the highest ever recorded for the past 27 months. And that's where I will start my conversation on the domestic commodities market with Temitope Odubide of Financial Derivatives Company. Hi, Tope.
Hi, good
Good to
morning,
see you.
Tuesday.
Good
Good to see you
morning.
again.
12.82%. Well, you saw this coming, right? This is
Yes.
in line with your forecast. So
Yeah.
what are the market fundamentals or factors that perhaps must have driven this growth?
Okay. So like you said, it was in line with our projection, our estimate of 12.8%. And we saw that it was the 11th consecutive monthly increase. And, we saw that food inflation remained a major culprit, right? We saw that it increased by 0.3% to 15.48%. And, that's interesting because this is the harvest season. This is a season where, we're supposed to see the influx of, some of these domestic commodities. And that should, the increased supply should bring down prices.
So why is it rising?
Because we're seeing that, there's still that, as much as we talk about the global chain, supply chain disruptions, we also had, those domestic supply chain disruptions due to the COVID pandemic. We saw that, during the lockdown restrictions, getting goods from the farms to the market was a challenge. And we see that those challenges still linger on. And that's the reason why food inflation is still stubbornly high at 15.48%. We're still seeing the disruptions to supply of these domestic commodities. But, the good news that we saw is that, core inflation, that was kind of surprising. But,
So
we
what
saw
does that imply?
that implies that, there's still that, when you look at core inflation, that's, you're removing all seasonalities of, agri-commodities, harvest season, planting season, seasonalities. We're looking at factors like, exchange rates. We saw that there was that limited, if we can use that word, exchange rate pass-through effect, because your global supply chain disruptions are not fully back to pre-pandemic levels. So you see that has not, while we have the currency devaluation, we have not seen the full effect of what it would have on imported goods, because you're still having that supply chain disruptions from, your markets abroad. But when everything fully opens up, we expect to see that imported, and that's why imported inflation just increased marginally by 0.1%. When we open up everywhere, and as we saw, the international airports are going to be reopened, we would see that effect play out on imported inflation.
Now, this food inflation that we've seen rising, and then with the pressure on the foreign exchange market, and then we've seen the foreign reserve dwindling. What's the correlation there? Does it have any impact on the food, inflation?
Yeah, so we would expect that impact, the impact of currency, anything that happens to the currency, on your core inflation or on your imported inflation, so because those are, where your exchange rates dynamics will play out. In your imported inflation, how much do manufacturers use to, import these inputs, and how would that reflect on, the goods you see in the market? Because we're a highly import-dependent country, would see that, your imported goods that you will find in your supermarket would start to increase. And we're already seeing that trend already playing out. Your flour, too, would have an impact on your bread, which is a domestic produced commodity. That ripple effect, we'll see that play out as we open up the...
Now, in your inflation forecast, you noted that Nigeria is not an inflation outlier in the African continent. Now, how would you compare Nigeria with other African countries like South Africa, Ghana, Angola, and of course, Uganda?
Yeah, because we tend to, feel like this is a Nigeria-specific problem of rising inflation. It's really not, because if you look at other countries to their, as long as you are import-dependent and you have that dependency on imported goods, you would see your inflation increase. And, especially in a time of, dwindling consumer disposable income, and you see currency, African currencies, they are weakening in light of this COVID pandemic. So we see that other African countries too, our peers in other sub-Saharan African countries too, are experiencing rising inflation. And, you see that the policymakers are now having to choose between rising inflation or supporting growth, because all these African economies generally have been affected by this pandemic. And that's the reason why many policymakers are choosing to go in the line of growth and, bringing down policy rates to support growth and boost employment. But inflation is not a Nigeria-specific problem.
Now, 91-day Treasury bill rate is flat at 1.2% per annum. What's the correlation between this and the inflation number?
Okay, because you see that when investors borrow money to the government using T-bills, right, what you get is not really what you get if you put it in context with inflation. Because you see that at 91-day T-bills at the last auction, primary market auction, was about 1.2%. And inflation is rising to 12.82%. So if you put that side by side, you see that really what you're getting is a negative real rate of return of about minus 11.62%. And that has widened from what it was in January at minus 8.63%. So really, there's that disincentive to save. You don't, because when you put what you're getting versus what inflation is going to erode out, you are less likely to save. But the only thing T-bills have going for it right now and other government securities is the risk-free aspect of those securities, because you see that in light of these of this pandemic, the uncertainty everywhere else, you want to invest in something certain. You want that certainty from what you invest, and that's why most investors tend to go for risk-free assets like government securities. But really, you are less likely to save when you put it against inflation, and that would affect investment finance of government. And that's why you're seeing that we are more desperate, if you will, for these multilateral agencies, funds. We need them, like yesterday. So that's what's going on.
So do you see inflation hitting like 13% in August?
It is likely. It is likely because if you look at what happened in August that could push it a bit further, you could look at things like the Third Milan Bridge closure that happened at the end of July rather, which will now start to play out in August. You would have those supply chain disruptions that are still there, but by and large, harvest season should start to have an impact, lead to gradually, but that would still not be enough to push it. Maybe, but it will still not be enough to not put inflation to 13%.
All right, let's look at your commodity price movement there. What are the major drivers? Can you take us through that?
Okay, so we see that, like as I mentioned earlier, flour, we see that there's been that increase. That is, exchange rate passed through. You see that limited impact in commodities such as flour, and that could start to play out in domestic commodities like bread, And we also see that there are other commodities are also on the increase. We see Gary is also on the increase. But when you look at the harvest season effect, which should start to play out, we're seeing that is already playing out in commodities such as yam. When you see the new harvest and, you see a lot of new yam in the market now, and that is already bringing down the price of yam from what it was at 3,000 for a medium size to about 1,500 for a medium size. So we see that harvest season playing out only in yam, but we should expect to see the harvest effect play out in more commodities as we go on.
Now, you did mention, of course, the opening of the international airports. That will be on August 29, but that's coming with few flights. But then Ghana will be opening up its international airport September 1, and they're opening up fully. Wouldn't that have some kind of implication?
Yeah, I mean, it would have some implications, and we see that there's only 2 airports that are going to open, Lagos and Abuja. I mean, they are part of the Golden Triangle, and I feel like the most important impact it will have is on forex, because as you open up, we're still having that forex rationing challenges. Before, what was happening was maybe speculative, it was more speculative demand. As you see, Naira devaluation, you just buy your dollars and, you keep it. But now we're going to see that the traders, the manufacturers, the students, the people going on tours, that have missed their family and friends, they're all going to be fighting for this limited dollar availability. So it will be like, where are you going to get the dollars from? How are you going to get it? And at what
the CBN is about to resume giving out
to BDCs.
Selling to BDCs.
Yes.
Yeah.
We see that that should maybe it should ease a bit of the pressure, but it's still not enough, because when you look at the availability of this forex, we look at oil price is still not at where we used to be. Oil production has fallen to about 1.4 million barrels per day to keep up with our OPEC quota. So we see that there's that pressure on revenue, on dollar availability. So there will still be that shortage, and as more pressure comes into the market, we should see an impact on Naira.
Now, when CBN starts, when it resumes selling to the BDCs, are we likely to see the exchange rate at parallel market coming down? Currently, we have 475.
Yes. I mean, it really depends on how frequent and at what magnitude are they selling to the BDCs. If you just sell once a week and you see that the demand pressure triples when you open up the market, it really might not be enough to bring down the value of the naira at the parallel market, it might not be sufficient because what magnitude and what frequency are you selling to the BDCs as is going to be what will be on the focus of these demand, of these end users. And already end users are already jittery. End users are already saying what is happening to the naira, and as they're excited for the airports to be open, they're also worried about what rates they're going to be getting the dollar
And the
at.
availability.
Yes.
Right, let's look at the oil market. Investors, of course, are waiting on the ministerial OPEC Plus committee meeting. They're supposed to meet,
Tomorrow.
that's tomorrow,
Yes, tomorrow.
yeah, to review the oil market and compliance, with the Global Supply Reduction Pact. Do you see them making any change?
I mean, I think what it will focus on is the gloomy demand outlook, irrespective of the fact that economies are opening up. We still see that the demand outlook still remains gloomy. Even OPEC itself has come out to revise its 2020 oil demand forecast, and according to OPEC, oil demand should drop by about 9 million barrels per day. And if you even look at IEA, they're also projecting a decline of about 8 million barrels per day for oil demand. So by and large, they would be focusing on the oil demand outlook because that would drive if oil can start to climb back up. As much as, the members have reduced their supply to, prop up prices a bit, it still remains dependent on oil demand and how soon the oil demand recovery will start and, if it can be sustained.
All right, thank you for your time, Temitope.
Thank you very much.
Temitope Olumide is one of the research analysts with Financial Derivatives Company. We'll take a moment. We'll be back.